That is my area of expertise. I'm also joined by my colleague, John Joroge, who is also a supervisor within the IRA, and also Joseph Owor. We are going to speak on 3 topics, and I'm happy that Emma mentioned them in summary. So we'll first start with a summary of, rather an introduction of who the IRA is. Then we will move to the various requirements that we have for the various licensees that are in our market. Then we'll also talk about microinsurance, which is an area of interest for many startups that are coming into our market. So I will proceed to share my screen. I don't know whether I'm allowed to do that, Emma?
Absolutely.
Okay. So my presentation is on the introduction to the insurance industry from a regulatory perspective. And under this presentation, we'll talk about who the IRA is, why it was established. And of course, our aim as the IRA is to actually enable the insurtechs within our market to actually overcome some of the perceived barriers that are there as they develop the solutions for our market. So I think what we want to achieve is actually a general understanding of the regulatory ecosystem, so that at least you should be able to develop good, innovative solutions that actually meet the needs of our consumers. So I will present this presentation, and the agenda is as follows. So we'll have a brief introduction to the IRA. What is the IRA? How was it established? What are its functions? Then we'll also look at the insurance industry statistics, both at a global level as well as at a national level, in terms of premium, as well as penetration and coverage. And I think this is particularly important for the innovators within the room, because of course, it's important to understand the data that actually drives the development of the various solutions that we are trying to achieve. Then we'll also proceed to talk about the IRA's Innovation Hub project and the opportunities that lie there. And then finally, we'll have a summary. So the reason why we've tailored our presentation this way is so that at least all the participants can be at the same level. I am aware that some of the participants have actually been successful and have actually obtained regulatory licenses. So we just want to ensure that everybody's at the same level at this point. Okay, so the next slide. We really tried to brainstorm internally as a team from IRA as to what would be the possible questions by the insurtech firms within the second cohort or even future cohorts. And I think we were able to narrow these down to what I've shown on your screens. What are the regulatory requirements for operating insurtech firms in Kenya? Are there specific regulations or clauses that one would be able to refer to so that they can actually just follow? And secondly, as an insurtech, what license should I apply for? Is there a license category called insurtech? And what are the ongoing requirements for maintaining such a license? I think also as an insurtech, you'd want to know what are the limitations of the existing legislation for insurtechs. As you all know, innovation usually precedes regulation. So there are various limitations within the law. And finally, what support does IRA provide to insurtechs? So these are some of the questions that we have highlighted as possibly questions that would be asked of the IRA by insurtechs. So hopefully throughout our speaker series, we should be able to answer these questions as we go along. And of course, I don't know whether Emma mentioned at the beginning, the IRA has actually 2 speaker sessions. So this is the first one, then we'll have the next one on the 24th. So some of these questions will be answered today and also on the 24th. So before we introduce the IRA, it's important to give a context as to why regulation exists for the insurance industry, and this actually applies across the board. And I am aware that we actually joined by regulators from various jurisdictions within Africa. So as you all know, insurance is an industry that is vested with public interest. There's a famous author by the name of Robert Klein who said, "The economic well-being of every citizen is strongly affected by the adequacy of the insurance protection, both formally and informally. So of course, governments have over time become involved in mandating as well as providing insurance. Okay, I'm told there's a problem with the slides. Just a moment. Let me just share that again. So I don't know whether you can all see what I've shared.
Yes, now we can see.
Okay, sorry for that. So I will just move up slightly to the questions that we had asked earlier. So these are the questions that would possibly be asked by Insurtech firms. And secondly, now we would want to set the context for the insurance regulation across various jurisdictions. And what we're saying here is that insurance is an industry that is vested with public interest. And of course, governments have become involved in mandating insurance provision as well as regulating it. It's also important to note that insurance is a business of trust. And a lot of the time, it's also said that insurance is actually a promise, and insurance is inherently intangible. So a lot of people actually cannot or fail to understand what it means to actually be covered. Even at the IRA, we receive a lot of complaints where people say, I've paid this much in premium, yet my maturity amount is actually lower than what I've paid into the insurance contract. So where is the value? So the concept of being covered is very difficult to comprehend, and that is what we're trying to say, that there's an element of being intangible as well as the issue of insurance being a business of trust. So there's need for regulation to actually clarify some of those ambiguities that exist. It's also important to note that there are different players within the insurance ecosystem. We have the investors or the shareholders. We also have policyholders who want the claim settled in a timely manner. And of course, all these come to play in the sense that different interests are trying to achieve their respective goals. There are also information asymmetries between the various players. So we have the policyholders who may have more information or may try to select against the insurance company so that they benefit. On the other hand, the insurance may have more information as to how much they would want to charge for a specific policy, so they can actually overcharge. So there are various information asymmetries between the various players within the insurance industry. Okay, so moving on, still setting the context, these are some of the players that are within in the various insurance markets across the world. So we have, of course, the insurance stakeholder, who can also be a consumer. We also have the insurers and reinsurers. We also have the insurance intermediaries, and my colleague John will talk about some of the requirements under that specific category. We also have insurance service providers, which is also a license category for the IRA. We also have other non-state actors, such as the NGOs that exist, and we also have government, which is, of course, an interested stakeholder within the insurance industry. So what is the IRA? So the IRA is a semi-autonomous government agency charged with the mandate of regulating, supervising, and promoting the development of the insurance industry here in Kenya. It's important to note that prior to the establishment of the IRA, the regulation and supervision of the insurance industry was done through the Ministry of Finance, and that is the National Treasury, which had a department. Also, in terms of it being semi-autonomous, it's important to mention that in its governance structure, the IRA actually has board members that are actually appointed by the Minister of Finance, as well as statutory office holders from the various financial sector regulators. So there's an element of independence, but at the same time, there's also a level of control. And that is why we are saying it is a semi-autonomous government agency. Then it's important to also note that the IRA was first formed on 1st of May 2006 through an amendment to the Insurance Act, which is Chapter 487, Laws of Kenya. So that is an introduction to who the IRA is and what are its key functions. So IRA is involved in licensing all persons that are involved in or connected with insurance business. And by this, we mean that the IRA actually enforces the standards that are provided within the Insurance Act. So for the various license categories, for insurers, the requirements could be in form of capital requirements or corporate governance requirements, as well as other fit and proper requirements. For the other license categories, there may be requirements for professional qualifications, which also the IRA looks at before licensing. So the IRA also enforces the standards for the conduct of insurance business. So within the Insurance Act, it actually specifies what are the various rules that must be followed for you to actually conduct insurance business in Kenya, and those are the standards that the IRA enforces. In addition to that, the IRA actually issues guidelines and prudential standards on various issues. And in fact, what Joseph will be presenting, which is a microinsurance regulation, was developed within the IRA, as well as other regulations that the IRA from time to time develops for, of course, for various goals that it wants to achieve. The IRA is also involved in consumer protection. We also, and by that I mean we're involved in complaints handling. Whenever there's a dispute, we have a dedicated function that actually deals with consumer protection. We're also involved in consumer education, which means publicizing or making the general public actually aware of what insurance is. As you know, the insurance coverage is fairly low within our market, but of course, this has substantially grown over time. Finally, we are involved in the promotion of the development of the insurance industry. As you know, even the innovation activities that have been developed in partnership with other partners, including the FSD, as well as the UK Aid, were actually initiatives aimed at promoting the growth of our market. So those are the main functions of the IRA. In terms of key statistics, how does Kenya compare against the rest of the world? And here we're looking at the premium volume, the penetration, as well as the density. And the reason why we are doing this is because these are globally accepted standards or metrics for comparison. So in Kenya, our total premium for the year 2020 was actually 226 billion. And in terms of our market share, we were 0.03% of the global market share in terms of premium. We were ranked number 58 in the world, but also fourth in Africa, after South Africa, Morocco, and Egypt. In terms of penetration, Kenya is ranked at 2.2%. And I think it's important for me to clarify here that the penetration is not in terms of the number of people who actually have insurance, but it's actually the insurance premium relative to the GDP. So the global average is 7.4%. In Kenya, we are at 2.2%. So there's, of course, room for growth in that respect. We'll also look at the actual coverage of insurance in terms of life, which is a different metric. And it's also used to assess how developed the insurance market is. In terms of penetration, we are ranked 57th in the world, but also we are ranked 4th in Africa, right after South Africa, Morocco, and Tunisia. Finally, we have the insurance density, which is the measure of the gross premium income over the GDP. And we are ranked 81st in the world, but also 4th in Africa. So it's important to understand these metrics so that we can be able to identify what opportunities exist within our market. Now, moving locally and looking at the specific numbers, we can look at the specific metric that I was talking about earlier, which is on the number of lives that actually have any form of insurance, which is, I think, row number 8, which is 11.7 million currently. And this actually translates to the insurance cover of 24.5%. So this is actually the metric that a lot of people usually confuse with the penetration when they say we want to grow our penetration from this rate to 100%. So this is actually the number that you can grow from 24% to actually 100, whereas the earlier penetration is measured relative to the GDP. So there's potential for growth, and I think as innovators within the cohort, it's important to understand these metrics so that you can actually develop products that are suited to offer additional coverage or additional access to those that are currently underserved. Okay, so I will move to the next section, which is on the classes of business that are transacted within the Kenyan market. So we have two main categories of insurance here in Kenya. We have the general insurance, and we also have the long-term insurance or life insurance. So these are the main classes, and I know that some of the cohort members have actually tailored their products to address specific needs within specific lines of business under both general and long-term insurance business. So it's important to understand these are the various lines under which the products can actually be developed. So the next section, which is on the role of policy and regulation in Insurtech, and here what we're trying to say is that, of course, innovation is expected to bring greater consumer utility in terms of expanding the access of products or also enhancing financial inclusion, but there are certain risks that can actually emanate from the innovations that are developed. And in particular, we would talk about the issues relating to data privacy, issues of cyber risks, or also money laundering. And therefore, various regulators have decided to adopt different approaches to address innovations within the various markets or jurisdictions. And this, of course, can either be passive or active. And I can say that as the IRA here in Kenya, we have decided to adopt an active approach where we would want to actually engage the insurance industry or those innovations that are coming up through our Insurtechs through the various initiatives. And I'm going to talk about those initiatives now. So we have the Insurance Innovation Lab, which is the Bima Lab, which we are actually fortunate to have partnered with the FSD as well as Telistic to actually deliver this specific innovation activity under the Bima Hub Innovation Project. We also have the Insurance Regulatory Sandbox, which is the Bima Box, where ideas that have actually been developed or have obtained proof of concept can actually be tested within a safe and conducive environment, with, of course, failure being contained within the regulatory sandbox. We also have an initiative on the Insurtech Bootcamp as well as Hackathon, where we are trying to encourage innovation through competition. We're also trying to encourage students within the universities actually showcase some of the solutions they may have to the IRA as well as the wider insurance industry. Then finally, we have the last pillar or component, which is the regulatory tech or RegTech. As you know, the cost of compliance has actually increased over the years, and therefore a number of innovations have come across where people are actually trying to leverage on technology to help them comply. So we've seen these initiatives coming through. I'm not sure whether we have one within this cohort, but it is an area that would need further development and research as well. But it's an emerging technology that the IRA has identified and we would want to actually encourage and incubate. So in summary, the IRA is a body that is a government agency that supervises the insurance industry here in Kenya, and it does so by administering the Insurance Act regulations and guidelines. The data shows that there are still opportunities for growth within the insurance industry, and at the IRA, we do believe that innovation can actually help catalyze that growth. At the IRA, we are committed to supporting the innovations that come through our Insurtechs, and that is why we are part of this program, and that is why we actually want to support the members by guiding them through the regulatory process or hurdles that they may face throughout this cohort as well as future cohorts. So at this juncture, I will stop there. I think Emma will guide whether we will take questions or we invite John to give the specific regulatory requirements for the various license categories. So thank you very much.
Thank you so much, Moses, for that overview and introduction. I will, as I said, pause after each speaker. If there are questions that you sort of urgently want to direct to the speaker who just shared, this is your opportunity. Otherwise, we will have Q&A at the end. So, you know, just in case there's anything you'd like to ask Moses directly, I'll give us a moment. You can either drop your question in the chat, or you can raise your hand, or of course, you can unmute and ask your question.
Hi, everyone. Just a quick one for Moses. Is there any relationship between Bima Lab and Bima Box?
Yes, thank you for that question. Let me just bring up the slide. So initially, the idea was that the Bima Lab actually targets ideas that are in concept or ideation stage, and of course, concepts that are trying to achieve, you know, the proof of concept. And thereafter, we were hoping that we would have the sandbox as a place where these ideas would actually be tested. So if you were successful in the innovation lab, then you would ideally graduate to the sandbox. However, the way we started our program with the Bima box is we actually invited applications that were already in existence within the market that actually would have wanted to test. So we actually did a call for applications for the sandbox, and we have a separate cohort for the sandbox. So currently there is no relationship, but ideally one would transition from the innovation lab to the sandbox. So that is the relationship. I don't know whether I've answered your question.
Yeah, you did.
Okay.
So basically, the innovation lab, the participants are allowed to face the market without the scrutiny of the regulatory sandbox. Is that so, or do they have to transition into the Bima box first for that to be tested?
No. Currently, you see, for the Bima lab, we are still in concept phase. So you would not be able to actually directly transact with the market. Maybe the only route currently through the Bima lab directly to the market would be to partner with an already licensed entity, or you yourself actually obtain a license to actually transact. So that is the criteria. So you are not able within the lab to actually roll out your product within the market. However, in the sandbox, the idea was that you would have an approval to actually transact within specified parameters and for a specified period. So that is what you would need to demonstrate as part of your application to the sandbox. So under the Bima lab, you're actually not able to transact directly with the market. I hope I've answered your question.
Yeah, you did. Thanks.
Okay. I don't know whether there are any other questions.
And of course, if you think of questions as the session continues, you can drop them in the chat, and we'll also answer them at the end. Oh, Kevin, I believe, is that Kevin?
Oh, sorry.
Kevin, did you want to ask a question?
I'm trying to. Sorry, just proceed.
Okay, perfect. All right, so with that, I'm going to quickly introduce our next speaker. So Moses, thank you so much for that. We are now going to have an opportunity to hear from John, who'll be able to introduce himself and then share a little bit about what he's speaking about today. So with that, John, I'll hand it over to you.
Well, thank you very much, Emma, and the team at the Bima Lab. My name is John Joroge, and I'm a supervision officer at IRA. I've actually been a supervision officer at IRA since June 2010, so that makes it about 11 plus years, supervising and regulating the insurance industry in Kenya. So my background is more of supervising of the insurance companies, but I also talk about more of the other players who we also regulate. And for example, the agents, the brokers, and the other service providers. So my background is more of in actuarial science, but in terms of experience, I've done more of supervision work compared to the actuarial bit. So I'll share a bit, or I'll share my slides as we proceed. Let me just share them 1 minute. So I hope you can all see my slides. So this is what I plan to talk. This is what I plan on talking about. Good. Thanks for the confirmation. So this is what I plan on talking about during this presentation. I'll touch on the registration requirements of various persons that we license at IRA. By persons, I mean it can be a natural person, or it can be a company. And I'll also give a highlight of who the regulated entities are and a summary. It's more of an overview of the registration requirements that we have at IRA. Then after that, we'll have a question and answer session, which will still be extended towards the end of the presentation, all the presentations, and I've been told there's another session on Friday, which you can also handle more questions.
Sorry, John, your slides are actually not moving.
Oh, sorry. Let me just. Are they moving right now?
Maybe just try clicking the next slide. No, there's no change on my end. Let me come and check.
Or just to seek a confirmation whether my slides are now moving. So I've just clicked on the next slide.
Yes, they are.
They're moving now.
Good, thank you. Sorry about that. So I'll just proceed with my presentation. So the first, it's an important point to understand how IRA comes in when it comes to regulating and giving licenses to those particular players in the insurance industry. So this will form the basis under which whether we need to, the big question is what are the regulations surrounding the licensing of Insurtechs. So based on this, we'll actually build on this as we proceed. So when it comes to the Insurance Act, so Section 19 of the Insurance Act states that only authorized persons to carry on insurance business. So what that means is by the definition of authorized persons, it means insurance companies. So this means any person who wants to operate as an insurance company, the business of undertaking liability in exchange of, for example, a premium, they must be licensed by IRA. So the second important point to note is in Section 150 of the Insurance Act, it talks of only registered brokers, agents, risk managers, loss adjusters, motor assessors, insurance investigators, surveyors, and claim settling agents can carry on insurance business in Kenya. So it's based on this. It's important now to sit back and think of where exactly does where do Insurtechs actually come in. So if I just borrow the definition, I'll just read out in terms of the definition of Insurtechs, how it's been defined by various people. Some people define Insurtech as technology-enabled innovations in the insurance industry. So it's more of a technology-based innovation, and the innovative use of technology in insurance. And another definition is the technology that lies behind the creation, distribution, and administration of insurance business. So based on that, and having the legal requirements that we have, we only regulate anyone who's to transact as an insurance company under Section 19, and anyone who's to operate as a broker, agent, risk manager, or those particular intermediaries and service providers, as highlighted below. So when you look at Insurtechs, you find unless you primarily fit into any of the two categories, it's a discussion we're actually having earlier in the office. We may not necessarily have to regulate Insurtechs directly. I'll take an example. What I did is I went through the Bima Lab 2 Insurtech Accelerator candidate selection report, just to see the profile of the 12 candidates who were selected. And I noted that most of them had actually, it's more of have business ideas which are technology driven on how they can partner with an insurance company. For example, I don't know if they're also in this particular forum, but if you see there's Orbit KE valuers who are in their proposal, they're more of a digital motor assessor. So in such a case, it's like what Moses was saying. For them, we have a classification of licensees called motor assessors. Our requirements for motor assessors do not necessarily say this will only apply to a traditional motor assessor, but it's to any type of motor assessor, if be it like this case, in the case of Orbit KE valuers, a digital assessor, or in the traditional case, for example, Regents or AA valuers, both regulations will apply to them. And it's something I was actually looking up Orbit KE, and I was actually surprised to see that they've actually been issued with a license to operate as a motor assessor in Kenya, which I think the license was issued a few days ago. So like another candidate, if you look at Red Pair Communications, and see for them they're offering personal accident cover, which actually works without human intervention. And how they're doing this is by partnering with an insurance company. So in this particular case, we may not necessarily have to license Red Pair Communications, because what they're doing is just having an IT solution and partnering with an insurance company so that they can help sell the products. So if you look at even the others, like I've seen MobiSure, which is more of a telematics, which is more a similar thing, a technological solution to motor insurance. How can insurance companies be able to monitor the behavior of their customers and be able to price them based on that particular behavior? So we have MobiSure has something similar. We have a similar product that is actually currently being sold by ICEA, Lion Insurance Company, and Heritage. So in this particular aspect, like the examples I've given, these Insurtechs are technology solutions that do not, if you look at Section 19, do not necessarily undertake liability. So they are not insurance companies, and they are not, for example, they're not selling the insurance product directly, so they are not brokers or agents, and neither are they risk managers, loss adjusters. But apart from Orbit KE, who's a motor assessor, you can see it's a situation where we may not necessarily, depending on the nature of work that you actually want to do, it may not have to come into the scope of IRA. A case in point, something that actually happens, I've seen SMART is among the partners. Most medical insurance companies actually partner with SMART so that they're able to integrate the insurance database with the hospitals, and all this is done through a technology that is provided by SMART. So in that case, SMART actually just provides a platform for integrating the two systems between the hospital and the insurance company, and in return earns a fee. So from where we sit, we don't, since SMART does not fall in any of these categories under Section 19 or Section 150, it may not be necessary at this particular point to have to supervise or issue guidelines on how Insurtechs will, may or may not be regulated. As Moses said, it's in Insurtechs, it's something that is developing, and it's something that we're actually actively looking at it, and hence the sandbox solution, which allows for, I think Kevin asked, we've allowed input participants into the sandbox, and allows, in case you have an idea that you want to try it out before taking it full scale into the industry, you can actually use the sandbox just to test it out without having, you may actually have, for example, you may want to do it as a broker, but at the moment you don't want to get registered as a broker, or you want to be an agent, and at the moment you don't want to be registered as an agent, we allow you to use a sandbox, which is an environment where it's controlled and allows IRA to monitor. And based on that, we're able to understand more of the products which are being offered by the companies. What are the risks? As Moses mentioned, there's data protection risks. There's the issue of cybersecurity. We have operational risks, which emanate from the people, processes, and systems. So I thought it would be helpful to just give that kind of background as we move forward. So moving on to the next slide. In case it hasn't moved, let me know. This is I've moved on to the slide on regulated entities. So these are in terms of everyone that we regulate in the insurance industry. So we have the insurance companies, which are 57 in number. So there's all that background in terms of who comprises of the regulated entities who fall under the jurisdiction of IRA. So we can see the biggest is insurance agents, and the biggest reason for this is I can speculate, but it's insurance is in Kenya, unlike most advanced economies, insurance where, for example, in economies like the UK, people will actually get out of the house to go out and look for insurance, for example, for their houses. But in Kenya, insurance is still seen more of a want and not exactly as a need. So you need people to drive the agenda and go out and sell insurance. So that's why you have so many insurance agents in the distributing players playing in our market. So what I'll do next is I'll move on to the next slide, which shows the requirements for each, but it's a very, very high level. The list is not exhaustive. In fact, it's probably just a high level, just insight into what you may need when you're actually getting a license. So I've combined, from this list, you'll actually see 13 players, but on this particular slide, which talks of the overview, in terms of registration requirements, I've only put 1, 2, 3, 4, 5. This is because I've bundled some of the players whose requirements are more or less similar. For example, let me just break it down. Insurance and reinsurance companies, I've grouped them together because they're all in the business of underwriting liability. Then in terms of brokers, so insurance brokers, reinsurance brokers, and medical insurance providers, I've grouped them as under the same categories as brokers. In fact, the unique thing with medical insurance providers, in fact, medical insurance providers are brokers, insurance brokers, but the only thing that differentiates them from insurance brokers is that they are allowed to do what we call fund management, and in return they are paid a fee. Our law stipulates that insurance brokers and agents are only to be paid by way of commissions. But in case a broker wants to go ahead and, for example, do fund management for medical in medical insurance, then they need to get another license as a medical insurance provider. So I've classified the three: the insurance broker, and the medical insurance provider as the same. The requirements will be more or less the same. Then we have insurance agents and bancassurance agents. Then from number 8 to 13, we call them insurance service providers, whose requirements are more or less the same. So they're in the providing services for the insurance company in terms of investigations, assessing, and settling claims. So back to an overview of the registration requirements. So I've put the requirements as the column, and the regulated entity to which it applies for, it's on the top row. So for you to be registered as an insurer or insurer, you must be incorporated. That is by law. Even for broker, you also have to be incorporated. That means you have to be registered under the Companies Act. But for an agent, it's not a must for you to be incorporated. You can actually operate as John Joroge, where you get a license as yourself, or you may actually register a business name, which, for example, I can register a business name as John Insurance Agency and operate under that business name without necessarily having to seek incorporation, whereas I can also incorporate in case I want to. The new category of agents is actually called bank assurance. And bank assurance these are actually insurance agents, and the only uniqueness with them, difference between a bank assurance agent and a normal agent, is that a bank assurance agent is 100% owned by a banking institution or an institution that is licensed under the Banking Act of Kenya. Then we have service providers, the list that I showed, that's number 8 to 13, who we can also operate, for example, as an investigator. I can be John Joroge, an insurance investigator, or I can incorporate a company under that name. In terms of the capital requirements, so all classes require capital except for an agent and a service provider. The capital requirements are for an insurer and reinsurer vary between 400 million to going upwards, can go up to 1.5 and above, because they are risk-based, and they are actually determined from a risk-based computation. So they're starting, if you're doing life insurance business, the classes that Moses had actually previewed a few minutes before. If you're doing a general insurance business, the minimum paid up capital you'll be required to have is 600 million Kenya shillings. In case it's a long-term insurer, the minimum paid up capital you'll be required to have is 400 million Kenya shillings. And in case you're a reinsurance company, for example, Kenya Re or East Africa Re, and you're doing both, reinsuring both general insurance classes and long-term insurance classes, your total capital, the minimum capital required will be 1.5 billion. So for a broker, your capital will be $1 million. An insurance agent actually requires no capital. And a bank assurance agent, let me just confirm that, requires a capital of 5 million Kenya shillings. And service providers actually require no capital. There are restrictions in terms of who can actually own a regulated entity in Kenya. So when it comes to insurance companies and reinsurance companies, there's a limitation such that a foreign entity or a foreign person cannot own more than 2/3 of an insurance company. So 1/3 of the shareholding must be owned by Kenyans. There have been exemptions. You can get an exemption to this. For example, there are companies which are 100% foreign owned. And for example, you have Prudential, which is 100% owned by, I think, Prudential UK. You have Ghana Reinsurance Company, which is 100% owned by the government of Ghana, and other such institutions. So for you to actually get an exemption, it's granted by the minister. So there is a process to that. But as it stands, there's a limitation on how much foreigners can actually own an insurance company in Kenya. There is, though, a discussion between the authority and the National Treasury on whether that particular requirement actually stifles, the ease of doing business in Kenya. So there's a discussion as to whether we need to remove that particular restriction on foreign ownership or reduce, but it's an ongoing discussion. For brokers, 60% of a brokerage must be owned by Kenyans, at a minimum 60%. For the other regulated entities, agents, bancassurance, and service providers, there's no restriction in terms of who can own an agency. So also in terms of the ownership restrictions, there is also a maximum threshold for insurance companies, which is no individual shareholder can own more than 25% of an insurance company. So in as much as, for example, in a case where you have a company that is foreign owned, you can have, for example, 40% is Kenyan owned and 60% is foreign, but also the 40 and the 60, it cannot be owned as a block. No person is allowed to own more than 25%. So you must have at least, that actually implies you must have at a minimum four shareholders owning 25% each if it's evenly distributed. Though, as I said, there are exemptions which are granted. As I mentioned earlier, Prudential, for example, is 100% owned by one shareholder, similar to Ghana Insurance Company, which is also 100% owned by the government of Ghana. There are no such restrictions for the other categories, that is a broker, an agent, a bancassurance, a service provider. This means they can be owned by one particular person. And the reason for that is in terms of governance. There was some risk that was emanating from how institutions are actually controlled, hence the requirement of a maximum shareholding per company. There are also governance requirements, noting that as Moses mentioned, this insurance is a business of selling promises. So we need companies to be able to honor those promises. So we have governance and professional qualification requirements. So insurance companies has a governance guideline which are in place, also with the bank assurance. And in terms of professional qualifications, as we said, we need these people to be people of integrity and must satisfy certain fit and proper requirements, given that they're in the business of they're selling promises. So for insurance companies, we require the management and the board to feel to have certain professional qualifications. Also for a broker, we also require, given that these are people who are giving advice on the type of insurance you need to buy and why it's necessary. Also agents, we also have and bank assurance and all the service providers. In addition to that, there's a bank guarantee requirement, or I've written as /lien. I'll explain what the lien means. Lien means, and actually applies to insurance companies, is there's a requirement that 5% of your total assets must be invested in Kenya government securities, either in treasury bills and treasury bonds. And those particular securities are actually encumbered, meaning that you cannot access it. It will be in your name, but you cannot access it. So in case you have a total assets of 1 billion, that means 50 million, at a minimum, 50 million must be invested in Kenya government securities. And the purpose of that is in case the company was to have financial problems, it will be a recourse when the company is being wound up, and some of those monies will be used to compensate the policyholders. Brokers are also required to hold a bank guarantee. They hold a bank guarantee of 3 million, because we've had cases. In fact, in addition to the bank guarantee, they also required to have a professional indemnity cover of up to 10 million Kenya shillings, because brokers can be sued for misadvising their clients. Brokers, the difference between brokers and agents, of course, brokers will be acting on behalf of the client, whereas the agent will be acting on behalf of the insurance company. So we don't have that particular requirement on the agent, given that he's an agent of the principal. So in case the agent was to missell insurance, then the fallback would be on the principal, who is the insurance company. So we currently don't have any bank guarantee or professional indemnity requirements on an agent. So for bank assurance, it's for this particular category of an agent, there is a requirement on a bank guarantee. In fact, the bank assurance guidelines were gazetted last year in I think in February. Before then, they were actually primarily operating as insurance agents. So on the service providers, there is no requirement on having a bank guarantee. So for all this, all the entities are required to apply for registration, and there is a licensing fee, which varies from category. So I've put an asterisk on insurance companies and reinsurers. This is because for insurers and reinsurers, they apply for a license once, unlike the other category, which have to renew their license on an annual basis. So for insurers, they have to pay 150,000 Kenya shillings, and our insurers are 250,000 Kenya shillings, and that is paid once. This is after adopting, recommendations from the insurance code principles, which say, if there's, which advocates for what we call a perpetual license, where you just license once and you monitor. And in case the company or the insurer or insurer has financial issues, you can always revoke a license. It's something that we're also considering, whether we still need to do annual licensing for brokers, agents, bank assurance, and service providers. But as it stands, this particular category of regulated entities have to seek for a license annually. For broker, the licensing fee is 10,000 shillings, whereas for a broker is 1,000 shillings. And for bank assurance agency, it's 20,000 shillings, and for service providers is 3,000 shillings. So those are the registration requirements on just an overview on the various entities that we regulate. As I mentioned earlier, now when you look at Insurtechs, and given this broad scope of who we license at IRA, there may be the question as to whether, at the moment, whether do we need to regulate Insurtechs on their own, or do we allow them to partner with companies? And probably in the future, it's when we can consider whether, based on what we observed, whether we need a separate license category for Insurtechs. But for now, these are the licensing requirements and the various categories of people that we license. So, and with that, I'm done with my presentation, and I'm open to any questions.
Hi, John.
Oh, hi.
So yeah, this is Louis from Emerging Markets. Thank you for the wonderful presentation. So I noticed the different licenses that you displayed. So my interest is in microinsurance. I want to know whether how many microinsurance licenses or companies we have, and if you've captured them anywhere that you could share with us.
Okay.
I know the regulation was passed last year to, I think you guys are now granting licenses. Maybe you could also clarify that, whether that's open or how far have you guys gone on that?
Okay, thank you for that. Sorry, I didn't capture micro insurers in my list of regulated entities, but that's okay. So it is true we passed micro insurance regulations, and the need for that was brought by the need to have companies that specifically target the underserved and say the low income population in society. What was happening prior is, if you look at the classes of general insurance business, microinsurance was being offered by the conventional insurance companies. But one of the issues that we noted is a company would design a microinsurance product, but will move ahead and treat the policyholders as conventional policyholders. For example, in the Insurance Act, it says insurance claims should be paid within 90 days. But when you look at somebody who will, somebody who's in the target market for microinsurance product is the low-income population, like what we have in Gikomba. And so, if you find such a person who actually lives, most of the time he sells his wares at the market, and that's that's all that he has to rely on. So if you subject such a person, when, for example, there's a fire in the market, and you subject them to having to wait for 90 days, we felt it's a bit unfair. And we realized that it would be impossible for the conventional insurance companies to be able to properly manage the microinsurance policyholders, given that the same person in claims will be treating, it will be very hard for them to separate, this is a microinsurance claim and this is a normal claim, therefore let me prioritize and how short a span I should pay the claims. So we came up with the microinsurance regulations, which actually allow for the registration of microinsurance companies. I won't talk so much on that, but I can say the regulations are there. We have received a number of applications, because then the next speaker actually is Joseph Owor, who handles the licensing of microinsurance companies. But yes, the regulations are there. We have received a number of applications, but we are yet to issue any license on the same. But I'll allow, if you allow, I'll let Joseph talk more on that in the next presentation.
Wonderful, thanks, John. It looks like we have a question from Amitaj Singh in the chat. I'm not sure if that's something we want to answer at the end and hand it over to Joseph to share. But his question is around regulatory requirements like inclusivity solutions or PULA. So if these are categorized with service providers. John, is that something you can answer?
Okay, yes. So for example, in the case of, let me pick, I think you mentioned PULA. PULA works more on, in the scope of the index-based products. So the interesting thing with PULA, what it does is it works as an agent by trying to sell the products on behalf of the companies. So the companies that have the index-based products. So in that particular point, it actually works as an agent approaching which the client is the government and trying to sell this product on behalf of the company. So in that case, PULA actually has a license as an insurance agent. In addition, it's also a claims, for index-based, it also works and it also tries and, okay, actually not even tries, it helps settle the claims when they are incurred. So in that case, they actually have another separate license as a claims settling agent. And the third license that they have, I can't remember what classification it is, but they actually have 3 licenses. As a claim settling agent, as an insurance agent, and it's just that I can't remember the third category, but they're actually operating under the 3 licenses. So I hope that actually helps to answer the question.
Thanks, John. And Amitaj says it does. So with that, I am going to switch us over so Joseph has time to present. And then after that, if you have questions that you want to answer, we'll be able to get those answered as well. So with that, I'm very excited for you all to have a chance to meet Joseph. Joseph, please feel free to introduce yourself so we can get to know you a little bit better and particularly to learn about microinsurance.
Thank you so much for this opportunity. I'm going to take you through the microinsurance regulations, and I'm sorry that I did prepare PowerPoint slides, but I'll go through the regulations because they are just around 5 pages long, but I'll just be going through quickly through the key provisions. As a way of introduction, my name is Joseph Owor. I joined the Insurance Regulatory Authority in 2013, having worked in the insurance sector for around 7 years. Vast experience in microinsurance. I worked with the consultant that was actually hired by the World Bank from policy paper to regulations. We actually developed the microinsurance policy paper in 2014, which was then which informed the drafting of the regulations. And the regulations were actually passed in they were gazetted in February 2020, and later on passed by Parliament in October the same year, 2020. So if you allow me, I'll quickly just want to share the regulations and take you through the key provisions in the regulations. I hope you are able to see what I'm sharing.
No, we cannot see, Joseph. Oh, yes, now we can see.
You can see. Thank you for that. So these regulations, I think it follows the same format of the drafting that is adopted under our Kenyan law, especially as per the Statutory Instruments Act. And we normally start by way of giving some brief definitions of some of the key words that are used in the regulations. So we were in these regulations, we have tried to define what is a bundle microinsurance product to mean any general insurance business microinsurance product that covers one or more classes of general insurance business, long-term insurance business, and both general and long-term insurance business. Then, of course, we have also tried to explain what exactly is a general microinsurance product as per these regulations, which we have defined to mean health insurance contract, any contract covering personal belongings, including dwellings, livestock, crops, and tools of trade. And again, as per, of course, I'll take you through the key provisions on the microinsurance criteria, which basically defines what would qualify to be a microinsurance product under these regulations, and for purposes of product approval within the authority. Then we also tried to define the term fixed sum insurance, which is basically a contract under which an agreed specified sum is payable or agreed specified fixed benefits shall be provided by the insurer to the policyholder on the occurrence of the insured risk, regardless of the actual loss or damage suffered by the policyholder. I think for those of us who are familiar with the insurance matters, we used to have a period in our market when we would have what we used to call agreed valued policies, especially for motor insurance, for instance, where at the beginning you agree with the insurance company that I'm insuring my car for such a given value. So it doesn't matter whether there is an inflation along the way or what they used to call depreciation. So at the end of whenever there is a claim, you would be paid the exact amount that you had agreed with the insurer at the beginning of the contract. So basically, that is the concept we are talking about here under fixed sum insurance contract for microinsurance. The term grace period, basically, it would be the period immediately following the premium due date, which a payment can be made to continue a policy in force without interruption. So normally, you find insurance companies giving policyholders what we would define as a grace period. So during that period, let's say most companies talk about, let's say, 21 days. So if within that 21-day period you have not paid your premium and there is a claim, it will still be paid whether there was a premium not paid or not. Then, of course, life insurance product, you just define it the way it is used under conventional insurance. Then there's this concept about a master policy holder, where groups come together. Let's say, like, what example could I give? Where maybe, let's say, a merry-go-round, and the members decide to buy insurance policy. Let's say a group life policy for the members. They will have to agree on who will be considered to be the master policy holder. This is a person that is representing all the other members of that particular group. So basically, we are talking about this is the person who is the legal holder of the policy issued in respect of that contract, just on behalf of the members of that particular group. Because microinsurer is a person registered under the Act to carry on microinsurance business. We have also tried to define what is microinsurance business under these regulations, which means insurance that is accessed by or accessible to the low-income population, including the underserved markets, provided by a variety of different entities and managed in accordance with the generally accepted insurance principles. So the key word here is accessed by or accessible to the low income. I think John made some reference to that point, that the target market here is the low income or the underserved. And I think at this point, I just want to make it clear that these regulations provide that even if you don't qualify to be categorized as a low-income member of the population, you can still buy a microinsurance product. I think that is what we were trying to clarify here. So you could be here, you could not be low-income, but you don't have products that basically will suit your needs. So that is now where the word underserved markets come in. Then we have also tried to define a microinsurance actuary to mean a person who holds the qualification of certified actuarial analyst at a minimum. I think the key point here is that we wanted to make it a bit affordable for the dedicated microinsurance companies to be able to hire a lower qualification of actuaries. And of course, we are aware that this is one profession that the fully qualified, the fellows are very expensive to hire, and we just wanted to make it cheap for the dedicated microinsurance companies to be able to hire a lower category of actuaries. And then I think the last definition here is the waiting period, which basically is the period required to wait, an insurer is required to wait before some or all of that person's insurance coverage shall come into effect. I would want to use an example, a very good example here of a medical insurance cover, where most policies you will find give a waiting period of beyond 9 months for pregnancy-related complications, because the insurance would argue like if you are taking insurance when you are, let's say for a lady who is already pregnant, then it would appear like the intention was to cover that particular pregnancy, which is not really insurance for that matter. So that is an example of a grace period. Then, of course, we normally, under our regulations, as per the drafting requirement under the Statutory Instruments Act, we would talk about what does the regulations cover, which is now the scope, and then now we go deep into now the specific provisions. So these particular regulations apply to any person engaged in microinsurance business. And then the grace period here for microinsurance contracts shall be at least 45 days from the date when the premium falls due payment. So I'd given an early example of 21 days, but for these particular regulations, we are providing for a grace period of 45 days from the date when the premium falls due for payment. What that means is that any claim that is incurred during the 45 days will be payable by the insurance company, whether the premium was received by the company or not. And then there's a provision here which would try to explain, where we are saying a grace period shall not be provided for index-based microinsurance products. I think a good example that I would use is where, for instance, if the index used is let's say rainfall as the index for a particular microinsurance product, you would find that we always use a very a very good analogy, like if, for instance, you've bought an index-based microinsurance product where the index is rainfall, and for instance, you are expecting to experience a period of drought, and then the rains start falling early enough before the 45 days that we provided for here. The motivation to pay premium becomes less and less. So that is why there is that provision that for index-based insurance products, there is no provision for a grace period. Then Regulation 5, which deals with the microinsurance criteria, basically the entire Regulation 5 provides for what would make a product to qualify to be approved by the authority as a microinsurance product. So basically, these are the things that we'll be looking at when approving products that have been presented to us for approval by the various entities that are underwriting microinsurance. So some of the key requirements include that the policies shall offer protection to an individual or members of a group and their property, and shall exclude third-party liability risks. If I would can explain a little bit why we are excluding third-party liability risks. Well, later on, I'll give you the requirements for registration of a microinsurance company, where, for instance, the capital requirement is way below what we require for the conventional insurance companies, which is 50 million. And for third-party liability, the limit of liability can completely wipe out the capital of a microinsurance company, because some of them, you saw, they are court determined, and nothing stop a court of law from giving any award, depending on the nature of the claim. So we have decided to exclude third-party liability risks for microinsurers. They will not be allowed to write third-party liability insurance. Then the contract term of the policy shall not exceed 12 months. So basically, for microinsurance products, it would generally operate like a normal general insurance product, currently being underwritten by the conventional insurance companies. And then we are saying that the policy may be renewable at the end of the contract term without the need for a new policy document, subject to the payment of premium. So at renewal, the policyholder may not really require a policy document to be issued by the insurance company. Then we are saying the amount of daily premiums or contributions shall not exceed 40 shillings, which basically is meant to make these products affordable, considering the target market that these products are, the underwriters of these products are supposed to target. And of course, we have also capped the sum insured not to be more than 500,000 shillings. We had tried to explain what a fixed sum insurance contract is. The policy shall not provide for a change of the product's features during the term of the contract. So we are basically saying that once the policy is issued to a policyholder, the insurance companies are not allowed to change the features of that particular policy unless it is at the time of renewal. Of course, several other factors would come into play at renewal, considering like probably maybe the loss ratio of the contract would have changed, and the insurance companies, while trying to protect themselves, might want to change some of the features of that particular policy, but not during the contract period of 12 months. It has to wait up to the renewal. Then the other requirement here is that the policy shall expressly state that the cover under the contract shall not commence until the premium has been paid, or where the contract provides for payment of the premium by installment, the first installment of the premium has been paid. But that does not really remove the fact that the policy must have a grace period within which the policyholder is allowed to to pay the premium. During that grace period, the cover will run as long as the contract specifies the period of the grace period, how long it takes. But we are providing for 45 days here. I think earlier I had mentioned that. Then the other provision here is on approval of microinsurance products. So we are requiring insurance companies, microinsurers, to apply to the authority for approval of a microinsurance product, just like currently we require under the conventional insurance business. And also, whenever there is a change in whenever there is a change in the terms of the product in accordance with the product approval guidelines, which would be issued by under the act. Of course, we have product approval guidelines already in place, which basically also provides for microinsurance products as well. So at the point of applying for approval of a microinsurance product, the microinsurer will be required to submit to the authority a sample policy summary, which basically summarizes the terms and conditions of the policy, and then the proposed commission rates or fee structures, a sales plan specifying how the product will be marketed and distributed, and copies of drafts of any agreements with intermediaries or other persons who shall be involved in the marketing or distribution of the product. So if the company is entering into an agreement with any party for purposes of marketing, we would require them to supply to the authority at the point of a product approval application any kind of agreements that they may have entered into with that particular party that will be involved in the marketing or distribution of the product. So the regulations provide for gives powers to the authority to revoke an approval of microinsurance products, which they have already approved, where in the case of an application by the microinsurer. So if a company has already applied for an approval of a product and then they come back to the authority to apply for a revocation, those are the grounds where the authority will revoke such a product, where the product ceases to meet the requirements of the act or these regulations, and where the microinsurer ceases to comply with the provisions of the act or these particular regulations. So those are the grounds upon which a product that has already been approved can be, the approval can be revoked by the authority. And we are saying here that any revocation will not affect any existing contracts. What we mean here is that when a contract is already running, let's say a policy has been issued and the 12 months period has not elapsed, any of such products, if which are withdrawn or revoked, for those ones which are still running will run up to the end of the contract period. So it doesn't affect the policy holders who already bought those particular products. Then the other provision here is that whenever a microinsurer wants to alter the microinsurance products features without the prior written approval of the authority, that will not be acceptable. An application to change the microinsurance products feature shall be accompanied by a written certification by the microinsurance actuary that the revised terms have been determined in accordance with the generally accepted actuarial methodologies. And for this particular provision, I think I stated earlier that this can only happen at renewal, not during the contract period. And that is what you are saying under Regulation 8.3, that a change in the microinsurance product features shall not be applicable to existing contracts. I think I also mentioned something about earlier about a master policy holder, which basically I said is the representative of a group that decides to buy insurance for group members. And the group must be identifiable and exist independently of the insurance contract. And we are also providing here that the group is not formed by an intermediary or a registered insurer, and then the risk insured under policy are related to the common interest or activities of the beneficiaries. Like say buying a medical insurance cover for members of a merry-go-round or a women group or any other youth group. So the interest is related to the common interest or activities of the beneficiaries. The other provision that is very key here is that where group underwriting is applied, there will be no price discrimination allowed between individuals within the group. So like the older members, for instance, older members of a group will not be charged different premiums to the other maybe young members of the group, or any member that has some maybe some chronic condition or something like that. So that kind of discrimination, these regulations does not allow. So for purposes of marketing materials, because of the target market, we are saying that the contract shall be in the same language as the policy document and shall be in clear, plain, and easy to understand language. I think what we are talking about here is that if the target market, maybe for instance, if the policyholder does not understand, say the common languages, English and Kiswahili, the micro insurer will be allowed to even offer the policy document even in mother tongue or any other language that the policyholder might understand. Then we have provided for a policy summary what will be contained in a policy summary. And we are saying it should not be more than one A4 page with a minimum font size of 12 or in an electronic format that captures similar details that it will have if it was in a paper form. Should be written in clear, plain, and easy to understand language. I think I've mentioned that. And with no or minimal use of technical and legal language. Of course, we are also trying to make the document understandable to the target market, avoiding the small prints that used to be the order of the day for policy documents in the insurance sector. And where any technical or legal language is used, that must be explained to the policyholder. And the same language as the policy document should be the same language that is used in the policy summary, and contain a summary of the cover provided and the key features of the policy. That would define the benefits under the policy, the issues to do with the sum insured, clearly explained how you arrive at the premiums, and things like that. So specifically, the policy summary shall contain the name of the microinsurer and the address of its principal office in Kenya, description of the insured risks and any exclusions or limitations that apply, the duration of the policy, the period of cover, matters to do with the grace period should be clearly explained in the policy summary, and any waiting periods that apply, if any. Then the principal benefits provided under the policy. And the policyholder must be told in no uncertain terms their obligation to disclose material facts, so that this does not become a bone of contention when there is a claim. The procedures for renewal of a policy, the claims procedures, and also the policyholder's right to complain. and how to lodge such particular complaint in case there is a dispute between arising out of that contract of insurance. Then lastly, we are saying that there must be a statement that the policy summary does not contain the full terms of the insurance policy, which are to be found in the policy document, and how the policyholder may obtain a copy of the policy document. So for policy documents, I think we are basically just trying to explain what would be contained in a policy document, which basically would include a statement that the policy document is written in clear, plain, and easy to understand language with no minimal or use of technical and legal language, will be easily understood by the person to whom it is marketed and sold. And of course, we are saying microinsurance policy document will be written in English or Kiswahili or any other language, provided that where language other than English or Kiswahili is used, the issuer shall provide an English or Kiswahili translation of the microinsurance policy document. It must state also that it is a microinsurance policy, and it should contain no or few exclusions. I think these ones I've mentioned earlier, that the name of the microinsurer should appear in the policy document, the name of the policyholder, the insured risk, issues to do with compensation to be made or the benefits to be provided on the occurrence of the insured risk, or whenever there is a claim under the contract. Any exclusions applicable to the contract must be clearly identified, and they also provide for the procedure for making a claim. So on the provision on claims payments, we have provided that microinsurer shall, within 10 calendar days of receipt of a claim notification under microinsurance policy, pay or reject the claim, and in the case of rejection, notify the claimant in writing the reasons for the rejection. We are putting an obligation on microinsurance intermediaries, and of course, by extension, by the microinsurer, that whenever a claim notification is received by an intermediary, such notification shall be deemed to have been received by the microinsurer. Of course, the intermediary here includes basically the agents, and in case a microinsurance product is sold through a broker, then the obligation is put on the microinsurer, that whenever such a notification has been received by an intermediary, then it will be deemed to have been received by the microinsurance. This is basically to avoid delay in the processing of the claim, where the microinsurer would shift blame to the intermediary that they have not seen that particular claim notification. Now, on registration requirements, we are saying that except as otherwise provided for under the Insurance Act, only a person registered in accordance with these particular regulations shall be allowed to do microinsurance business in Kenya. And the name of a registered microinsurer shall contain the word microinsurance in a microinsurance registered name. So, for instance, if your company is ABC, it has to be ABC Microinsurance Company Limited. Of course, they are supposed to be incorporated. So the name microinsurance must appear in the registered name of that particular company. Now we are providing that, we have given I think the last regulation we have given a transition period, but we are saying that any registered insurer currently doing the conventional insurance business must set up, who intends to do microinsurance is required to set up a separate microinsurance company for that particular purpose. But like I'm saying, we have provided a transition period of 3 years from the date of publication of these regulations for the current conventional insurance companies who are already in the microinsurance space to transit, or to be given time to set up a subsidiary that will be dedicated to doing microinsurance business out on, aside from their conventional their conventional insurance business that they currently run. Regulation 16 provides that microinsurance registration applications shall be subject to similar registration requirements as insurers under the Insurance Act, but with capital issues to do with annual registration and operational requirements are set out in these regulations. So for microinsurance companies, they will not be having a perpetual license, but they will be going through an annual registration process where you apply for your license to be renewed with the minimum paid up capital of 50 million shillings to when you are starting up. The risk-based capital as may be determined by the authority. And also the requirement is that microinsurers shall apply to the authority for the renewal of registration annually on or before the 30th of September every year. Actually, that used to be the requirement for the conventional insurance companies before we started the perpetual licensing. Then we are saying that the serving requirements for microinsurance products marketed or sold under the by a microinsurer shall be the same as for products sold under general insurance business. I think I mentioned that this will be annual contracts, and that is why we are providing that the reserving requirements shall be the same as under the current general insurance business sold by conventional insurance companies. So we have provided for issues to do with how complaints are handled by microinsurers. So we are requiring microinsurance companies to establish and maintain a function and the procedures for dealing with inquiries, complaints, and disputes arising out of the contracts that they have entered into. And they are required to resolve any complaint and notify the complainant of their decision within 7 calendar days of receiving such complaints. Now, on intermediaries, we have provided for under Regulation 18 on how the microinsurance intermediaries are supposed to be appointed. Okay, what we are talking about here is that currently all intermediaries, including insurance brokers and agents, I think John mentioned that they are required to be licensed by the authority. But for these particular intermediaries that will be involved in the selling of microinsurance products, we are saying that they will not require to be registered by the authority, and any microinsurer may appoint any person as a microinsurance intermediary, provided that the microinsurer is certified that the person is fit and proper to be a microinsurance intermediary. The person has successfully completed a microinsurance training program approved by the authority, and also the person shall be monitored and supervised as a microinsurance intermediary by the microinsurer who appoints them. Sorry for that. So the microinsurer will be required to keep and maintain a register of all microinsurance intermediaries that they have appointed, which would include the full name, business address, and contact details of each intermediary, the date of appointment and termination where applicable, the volume of business generated by the microinsurance intermediary by class or type, the source of microinsurance business, and the amount of commissions or fees paid to the microinsurance intermediary. And we are putting an obligation on the microinsurers who appoint the microinsurance intermediaries that they should provide at least at their own expense, at least 25 hours of training to all its microinsurance intermediaries at the time of appointment. And there would be requirement for a refresher training at least 15 hours after every 3 years to the intermediaries. And of course, we have provided them at the very minimum what the training should cover. Because basically, we are talking about the provisions of the Insurance Act and these particular regulations that should form part of the training for the intermediaries. The intermediaries are supposed to be trained on their duties and responsibilities in the distribution of microinsurance products to avoid issues of mis-selling, of course, considering the target market, which probably they may not be well knowledgeable on matters insurance. So issues of mis-selling can very easily disrupt the process. And then the specific microinsurance product that the intermediary shall be authorized to distribute, they're supposed to be taught about the features of those particular products, the entire insurance market, the state of the insurance market in Kenya, and how to handle claims and the claims handling procedures of that particular microinsurer who has appointed them. Then on commissions, we are saying here that the commission or fee payable to a microinsurance intermediary by the microinsurer shall not exceed 15% of the premium paid. So we have capped the commission for microinsurance products at 15%. Or even if they agree on a fee, then that should also not exceed 15% of the premium paid. Then we have, lastly, the last key provision here is the reporting requirements, where the microinsurers will be required to report to the authority regularly on the following matters, in addition to any other reporting requirement under the Insurance Act for conventional insurance companies. Any information in respect of microinsurance business as may be required by the authority. Quarterly information regarding the handling of complaints or grievances made against the microinsurer or their intermediaries, not more than 50 days after the end of the quarter to which it relates. Then annual reports on microinsurance intermediaries that were appointed by the microinsurer during the year, not later than 3 months after the end of the year in which the appointment was made. Then basically the last two provisions are just standard. Then on enforcement and the transition. So I talked about the transition period where we are saying that a registered insurer who is currently engaged in microinsurance business shall continue providing such products and regularize compliance with these regulations within 3 years from the date of coming into effect, into operation of these regulations. So basically, that is all about the regulations, and I can stop there and take any questions that the audience may have.
Yeah, thank you, Joseph, and for sharing your thoughts and walking us through the regulations. I already see a question in the chat window. Actually, there's now 2 questions from Lewis in the chat window. Are you able to see that, or would you like me to read it out for you, or ask Lewis to answer the question directly? And then Brian will come to you after that. I see your hand is up.
Can you just read the questions for me, please?
Okay, so the first one is, please clarify on product features change requiring approval from the authority. Wouldn't this slow down the innovation process? Changes could range from changing the mode of delivery to creating a whole new product. Do all these have to be reported to IRA? Please clarify, as I find this vague yet crucial.
Yeah, I think that particular requirement, even under the conventional insurance products, that is actually in the product guideline. We have product guidelines that require that particular change. Whenever there is a change in the product features, you need to come back to the authority for an approval. But normally, I think maybe my colleague Moses, who has been in the product approval before, would confirm that it doesn't take too long to actually get back to the applicant whenever there is a requirement for a change in the product features. Even the approval itself for a completely new product, it doesn't, because we have timelines within which we need to approve those products. So it doesn't really take too long for any product to be approved, or any feature that is changing of a particular product to be approved by the authority.
Thank you, Joseph. Just to add on to what you've mentioned, that of course we do have timelines within our service charter with which we must issue approvals. It's also important to note that the changes must be material. So if it's, a simple, typo, or, something very small, then we would not require you to file for that change. So the change has to be material. I hope that clarifies.
Okay, and then I'm going to read, because Louis had two questions in a row, and then Brian, I'll come to you before we go to Amit Toj Singh's question. So the second question was, given the small ticket premiums for microinsurance products, 15% seems low. Would you care to comment on how this was arrived at, or microinsurance players consulted?
Just a quick response on that. You know, when coming up with a new policy, because like I told you, we started with a policy paper on microinsurance, and the requirement under the Statutory Instruments Act, you have to engage all the stakeholders in this process from the beginning up to the end. So this particular provision was actually agreed with the stakeholders, both current players in the microinsurance space, or even other interested parties. And we held that stakeholder engagement at the point of coming up with the policy paper, and when the regulations were actually published, and we took them through again the regulations. So it is one requirement that actually was agreed with the players in this sector and beyond. And of course, we also tried to benchmark with the countries that are already in the microinsurance space, like South Africa, Philippines, Peru, what they were providing for India. So basically, it was something that was agreed with the players in this sector.
Okay.
Maybe just to add, I think in terms of the computations, one thing that I think maybe just to clarify what Joseph has issued. I remember we did some actual work on this when I was at IRA. I remember we were heavily involved in the computations just to ensure that in the long run, how do you ensure that the product is affordable? At the same time, for microinsurance, the key driver when it comes to such a product is basically the numbers. So in terms of, it's not an issue of looking at the percentage, 15% or 30% or be it 100%. The key thing about microinsurance is the law of large numbers. So if you would be able to get numbers, then you can even go further and reduce the commission rate to make your product even much cheaper. So that would ideally, you could see companies even having a commission of around, say, 5%, just because they are basically distributing this particular product with very innovative mechanisms. So one of the key things that maybe I want to highlight here, in terms of innovation, you need to think about reducing cost as an Insurtech. At the same time, the key driver in this for microinsurance is ideally numbers. Thank you.
Thank you, Elias.
Thank you, Elias. Okay, I think we've got quite a lineup of questions, so we'll go to Brian. I think, Brian, you had your hand up first, so if you can unmute yourself and ask your question.
Yes, so thank you so much, Joseph, for the presentation. So I have two questions. One is on group insurance. So in the document for microinsurance regulation of microinsurance products, it's mentioned that an insurance agency or an insurer cannot specify a particular group. So how do you as a regulator approve or determine the kind of groups that can be issued a policy? And can we have a group of minors who are grouped together and a policy taken on their behalf? Let's say in the setting of a school, can we group like minors who are under 18 and put them as a group so that they can get a policy? That's the first question. And the second question is that what is the common red flag that makes you as a regulator reject a new product? Yes, thank you.
Okay, thank you for that. I think if you look at the regulation that talking about the group policy, we had identified some particular conditions that must be met by the group. So we are saying that a microinsurer may offer a group policy that meets the following conditions. Of course, there must be a master policy holder, whom I think I defined who a master policy holder is. It's just to be in charge of the group on taking. So the master policy holder simply takes the policy on behalf of the group. But the key point here is that the group is not formed by an intermediary or a registered insurer. And there's also the issue of it exists independently of the insurance contract. So basically, you are not saying that you are saying that you don't come up with a group that for purposes of an insurance. There must be something else that is common to the interest of that particular group, not just insurance per se. So when a group is formed basically for purposes of insurance, then that particular group may not really qualify to buy a microinsurance contract or a product for that matter. So we are saying there must be some common interest or activities of the beneficiaries under that group policy, not basically coming up for purposes of buying insurance only.
Okay.
So can we say that a school is a group? Like the students in a school, can we categorize them as a group?
Yes, you see the common interest there is not basically insurance. Yeah, so that can form a group, and you can buy maybe an education policy for members of that particular school. But you see, what brought them together was not basically for purposes of buying insurance. That is what we mean by this particular provision here.
Maybe just to clarify, and if you look at the setting, so for instance, if you look at various schools, definitely if you're privileged to have a child, one of the key things that you'll be able to see in their fee structure is the insurance fees. Now, if you look at how those particular schools do it, that fee is basically for more of like a personal accident cover to the students when they are in school. So that particular cover is taken at a group level, at the school level, and within that, when the school is when the students are in school, then any accident that might happen to a child there, then that would be paid under that particular type of policy, like a group personal policy, accident policy. So in terms of schooling, there are various ways in which you can look at that as an Insurtech, and the key thing is that the way you kind of cover, they should have some common interest, and there are a number of covers that currently, whenever a kid is going to school, the schools do cover their students at each and every level, and that's why you'll get that students are required to pay for insurance fee whenever they go back to school at the beginning of each and every term or year.
Thank you. Thank you so much.
Thank you. Okay, I'm going to move on to Amitaj Singh's question, but before I do, just to let you know that we'll be running a series of office hours with the team from IRA. So even if we don't get to cover your question tonight, our office hours will kick off on the 6th with IRA, and you'll be able to book time very specifically with them to have your specific questions addressed by them. But let's utilize the last 2 minutes we have. So Amitoj had a question. It seemed to have been a follow-on on Louis' question, which was in addition to the question by Louis on new products, do micro insurers still have to go through the same processes other insurers go through for a product approval? Is there a way to fast track this? And then I'll shoot out the second question because the next two questions are related, and then we'll have the team respond. And then we'll wrap up with Swema, whose hand is up. So John Paul asks, the 50 million capital requirement, how much has to be invested in government bonds vis-a-vis working capital? And Amitaj goes ahead and asks, on the capital requirements, the 50 million is minimum paid up capital, right? Additionally, on risk-based capital for GI, we have 600 million as a volume-based minimum. Will the volume-based minimum also be 50 million for micro insurers? So I'm going to have you hold on to those questions. If you can go ahead and answer across Joseph, John, Moses, and Elias, that'll be great.
So I can take the first one on the product approval process by Amitoj. The answer to your question is actually yes, they do go through the same process. The timelines actually that we have for a complete submission are actually 10 working days. So for us, we feel that is sufficient enough time to enable us to have the back and forth between the IRA, our actuarial team, as well as whoever is applying for that. So yes, the answer is yes, they do have to go through the same process for approval of their products. Thank you.
Maybe if I can quickly comment on the question of 50 million minimum capital requirement. I think the way we have handled the few applications that we have had for registration, but I didn't mention that we've had around 6 companies that have applied to be registered as dedicated micro insurers, and out of the 6, we have given an approval in principle for three companies. That basically an approval in principle just simply tells the company, the applicant, that your application has been reviewed, and now you need to meet the requirements as per the Insurance Act and these particular regulations, the way we give them a list of all that we require. The way we have treated the investment in government, I think that is what John mentioned as a like you need 5. Is 5% of the total assets. For a new company like a micro insurer that is just starting up, the 5% we have treated it to mean is 5% of the 50 million that needs to be invested in government securities. That is how we have treated it, because these companies will be coming in without no specific assets that you may want to, because that is what we have seen of the few applicants that we have had. So the only assets that we are looking at here is this 50% minimum capital requirement. So that is how we have treated for the few applications that we have handled.
Okay. All right. And then as we wrap up, do you want to add something? Elias, yeah, go ahead.
Yeah, maybe just to comment on risk-based capital. I think that's an area that hasn't been touched. Now, if you look at the structures of various regulators across the world, and I think following up with what Kenya has, I would say, a very dynamic approach when it comes to capital, whereby we look at it on volume and other areas in terms of risk-based. So in terms of microinsurance, the 50 million is basically what we term as a minimum capital requirement, and that really falls within what you'll call the minimum. Then over time, assume that a microinsurance gets in the market, then it's writing premiums and risks worth 5 billion. You don't expect that company to have 50 million as a minimum. So ideally, what should happen, the capital should be proportionate to the risk and the volume, and over time, and maybe if you look at the regulation, it's very clear that it will be 50 or risk-based capital. So ideally, as you build your business profile and you carry more risk, then you would expect that your capital position will be changing over time. And what happens is that the 50 million will only relate to writing a certain level of liabilities. Then over time, then that basically changes. And ideally, maybe just to bring this home, you don't want to create what we call regulatory arbitrage within the system, whereby you'll get that if maybe I would write 5 billion of risk at 50 million, why should I then have the license of a fully conventional insurance company, which requires 600 million? So those are areas that, in terms of regulations, it's very important to weigh out that, to avoid that issues of regulatory arbitrage. So you would expect volume and risk-based capital also to come through when it comes to microinsurance.
Great, thank you, Elias.
Thank you.
Okay, so we're out of time, but I know Wema had his hand up for a while. Wema, do you want to go ahead and ask your question quickly, and then we'll wrap up the call?
Yes, thank you very much. So first, I think IRA is doing such an amazing job, so congratulations, guys. To my question, I think it was around page 2 that it was mentioned that the maximum premiums we can collect for microinsurance products is 40 shillings per day. So that translates into about 1,200 a month. And we know that there could be microinsurance products that are around savings, and this would imply that we are capping the amount that people can save to a maximum of 1,200 a month. So can we have so my question is, are there exceptions on the cap on the maximum premium that people can give for microinsurance products? Thank you.
Elias, do you want to take that? This is a question that has always come out in every other time we discuss these regulations. And Elias, maybe you could just quickly comment on how the actuaries reached that figure of 40 shillings.
Yeah, so I think, Joseph, you're putting me on the line because you might be aware that I was keen in computation of all this. But let me just kind of provide a background in terms of how then that 40 shillings was arrived at. Now, there are a couple of factors that were brought into consideration. The first thing that we looked at is ideally what would be the minimum wage in the country, and this was taken projecting that over time, whereby the 40 shillings, these are value that we are looking into a review, and basically this is what IRA would basically think about reviewing this over the next after the next 5 or 7 years, because that was how it was determined. And look, the issue here, you don't want to, again, create what we call an uncompetitive market. Now, the products that we are focusing on, microinsurance products, should highly be targeting those people that are in a way struggling financially, and basically getting 1,200 per month to put into insurance is something of hardship. So you don't want to really kill the conventional type of products because microinsurance is basically looking at the underserved and those people that are currently not insured at all. So within that particular amount, that would be the maximum amount. In fact, the amount that we should be talking about, it should be like 5 shillings per day. Not even 40 shillings per day, because 40 shillings is on the very high level, the highest point that you would think about for that person that is doing manual work and basically is a mujengo or a boda rider. That would be a very high amount. So that is something that I would expect IRA to review maybe in the next 5 or 7 years and check whether the minimum wage has changed. But if you look at the way the minimum wage in the country has been, the way it has been growing, I think the government didn't change that this year. And that's how we did arrive at the 40 shillings, and that should be the highest. But we'd expect us here as Insurtech, you can have a product that even pays a shilling per day, other than maybe requiring it to go beyond 40, because that would be ideally quite expensive to those people that are currently not insured.
Great. Okay, so I think we'll wrap up there and call it a day. I want to say thank you very much to the team from IRA, Joseph, John, and Moses. I think you did a fantastic job, lots of questions and good discussion. I want to thank everybody that joined us today, both from the cohort and then from individuals who are not part of our Bima Lab cohort. It's been a pleasure hosting you this evening. I wish you all the best, and we will see you all next week. Thank you very much.
Thank you.
Okay.
Thank you, guys.
Thank you.